Investing in stocks for beginners. Welcome to Be a Baby Billionaire. To get started with investing in stocks as a beginner, you do not want to jump in blindly, but to educate yourselves first. By understanding the nitty-gritty of the basics, you will be able to get your feet wet and buy your first stock. As you improve your skills on stock analysis, picking a stock and playing it in the open market, you will develop more confidence. The key is to learn and do. By doing so, you will be an expert in doing so for many years. Everything worthwhile starts incrementally, and as each day passes, that effort may help grow a large portfolio. Step 1. Set clear investment goals. The foundation of successful stock investing begins with setting clear investment goals. Take the time to define what you want to achieve financially, whether it's saving for retirement, purchasing a home, or funding your children's education. Setting specific and achievable goals provides you with a roadmap for your investment journey, guiding your decisions and strategies along the way. Consider factors such as your risk tolerance, investment time frame, and desired rate of return when setting your goals. By aligning your investment objectives with your financial aspirations, you can create a focused and effective investment plan that moves you closer to realizing your dreams. Additionally, regularly review and reassess your goals to ensure they remain relevant and achievable as your circumstances and priorities evolve over time. Once you've established your investment goals, it's essential to determine how much you can afford to invest. Conduct a thorough assessment of your financial situation, taking into account your income, expenses, savings, and debts. Building a solid financial foundation, including an emergency fund to cover unexpected expenses, is crucial before committing funds to the stock market. Remember, investing should complement your overall financial strategy and not jeopardize your financial security. Only invest money that you can afford to lose without compromising your standard of living or long-term financial goals. By carefully evaluating your financial resources and constraints, you can make informed decisions about how much to invest and ensure that your investment journey remains sustainable and rewarding in the long run. Step 2. Determine how much you can afford to invest. Before diving into the stock market, it's essential to determine how much you can afford to invest. Carefully assess your financial situation, including your sources of income, emergency fund, and any high-interest debts you need to pay off. Remember, investing should never put you in a financially vulnerable position, so only invest money that you can afford to lose. Start by establishing a budget that accounts for your essential expenses, debt repayments, and savings goals. Once you've covered your basic financial needs, consider allocating a portion of your discretionary income towards investments. By prioritizing financial stability and prudence, you can ensure that your investment journey is built on a solid foundation of sound financial principles. Additionally, start with small, manageable investments and gradually increase your investment contributions as your financial situation improves and your comfort level grows. By taking a disciplined and cautious approach to investing, you can minimize the risk of financial setbacks and lay the groundwork for long-term wealth accumulation and financial security. Step 3. Determine your tolerance for risk. Understanding your tolerance for risk is crucial in crafting an investment strategy that aligns with your financial goals and comfort level. Assess your willingness to accept market fluctuations and potential losses, keeping in mind that higher returns often come with higher risks. Start by evaluating your investment horizon, or the length of time you plan to hold your investments, as this can influence your risk tolerance. Generally, longer investment horizons allow for greater tolerance of market volatility, as there is more time to recover from short-term fluctuations. Next, consider your personal temperament and psychological attitude towards risk. Some investors may feel comfortable riding out market ups and downs, while others may prefer more conservative investments to avoid emotional stress. Additionally, factor in your financial situation and goals when assessing risk tolerance. Ultimately, understanding your risk tolerance is essential for building a balanced and resilient investment portfolio. that can weather market fluctuations while still aligning with your financial objectives. Step 4. Determine your investing style. Everyone has a different investing style, whether it's a hands-on approach or a more passive strategy. Decide whether you prefer managing your own investments or working with a financial advisor or broker who can provide personalized guidance. If you're comfortable conducting research, analyzing financial statements, and making investment decisions independently, a do-it-yourself approach may be suitable for you. On the other hand, if you prefer to delegate investment decisions to professionals or lack the time and expertise to manage your portfolio actively, you may opt for a hands-off approach. Consider factors such as your investment knowledge, time availability, and comfort level with risk when determining your investing style. Additionally, be open to adapting your approach over time as your financial situation and investment goals evolve. Whether you choose to be an active trader or a passive investor, selecting an investing style that aligns with your preferences and goals is essential for building a successful investment strategy that stands the test of time. Step 5. Pick your broker. Choosing the right broker is crucial for executing your investment strategy effectively. Whether you opt for a full-service broker, discount broker, or robo-advisor, consider factors such as fees, investment options, and educational resources when selecting a brokerage firm. Full-service brokers offer personalized advice and a wide range of investment products but typically charge higher fees. Discount brokers provide self-directed investing platforms with lower fees but limited guidance. Robo-advisors use algorithms to manage your investments automatically and often have lower fees and minimum account requirements. Assess your investment needs, preferences, and budget to determine the best broker for your situation. Additionally, research each broker's reputation, customer service quality, and regulatory compliance to ensure a positive investing experience. By choosing a reliable and reputable broker that aligns with your investment goals, you can confidently execute your investment strategy and achieve your financial objectives. Step 6. How to fund your stock account. After selecting a brokerage firm and opening an investment account, you'll need to fund your stock account. Choose between a cash account or a margin account, depending on your risk tolerance and borrowing needs. A cash account requires you to deposit funds before making trades, reducing the risk of overspending and potential margin calls. In contrast, a margin account allows you to borrow funds from your broker to increase your purchasing power, but it comes with additional risks and interest charges. Link your bank account to facilitate transfers and consider setting up automatic contributions to make investing a regular habit. Monitor your account balances and cash flow to ensure you have sufficient funds available for trading and investment opportunities. By funding your stock account responsibly and strategically, you can start building your investment portfolio and working towards your financial goals effectively. Step 7. Pick your stocks. Choosing the right stocks is essential for building a diversified investment portfolio. Consider various factors such as your investment goals, risk tolerance, and time horizon when selecting individual stocks or exchange-traded funds, ETFs. One approach is to invest in blue-chip stocks, which are shares of well-established companies with a history of consistent growth and dividend payments. These companies often have strong brand recognition, stable market positions, and a track record of weathering economic downturns, making them suitable for long-term investors seeking stability and steady returns. Another option is dividend stocks, which pay regular dividends to shareholders. By investing in dividend-paying companies, you can benefit from a steady income stream and the potential for capital appreciation over time. Look for companies with a history of increasing dividends, strong cash flow, and sustainable payout ratios to maximize your investment returns. Growth stocks are another category to consider, representing shares of companies with high potential for above-average revenue and earnings growth. While growth stocks can be more volatile than blue-chip or dividend stocks, they offer the opportunity for significant capital gains over the long term. Conduct thorough research and analysis to identify promising growth stocks in sectors such as technology, healthcare, or e-commerce, and diversify your portfolio to mitigate risk. Additionally, defensive stocks are worth considering, as they tend to perform well during economic downturns due to the essential nature of their products or services. Examples of defensive stocks include companies in sectors such as utilities, consumer staples, and healthcare, which provide stability and resilience in volatile market conditions. Alternatively, you can invest in ETFs, which are baskets of stocks that track specific market indexes or sectors. By choosing quality stocks that align with your risk tolerance and investment strategy, you can build a resilient portfolio that withstands market fluctuations and delivers consistent returns over time. Step 8. Keep learning about investing in stocks. Investing in stocks is an ongoing learning experience, even for seasoned investors. Stay informed about market trends, economic developments, and investment strategies by reading reputable financial news sources, attending seminars or webinars, and exploring educational resources provided by brokerage firms or investment websites. Continuously review and adapt your investment strategy to reflect changes in your financial situation, market conditions, and investment goals. Consider seeking advice from financial professionals or joining investment clubs or online communities to exchange ideas and insights with like-minded investors. Strategies for managing investment risks. While it's impossible to eliminate investment risks entirely, there are strategies that beginner investors can employ to mitigate their exposure to potential losses. Here are some key risk management strategies to consider. Strategy 1. Diversification. Diversifying your investment portfolio across different asset classes, industries, and geographic regions can help spread risk and reduce the impact of adverse events on your overall portfolio. By investing in a mix of stocks, bonds, and other assets, you can minimize the impact of any single investment performing poorly. Strategy 2. Dollar cost averaging. Dollar cost averaging involves investing a fixed amount of money at regular intervals, regardless of market conditions. This strategy can help reduce the impact of market volatility by averaging out the purchase price of investments over time. Strategy 3. Long-term perspective. Adopting a long-term investment perspective can help mitigate the impact of short-term market fluctuations on your portfolio. By focusing on your investment goals and staying committed to your investment strategy, you can ride out market downturns and capitalize on long-term growth opportunities. Strategy 4. Regular review and rebalancing. Regularly reviewing your investment portfolio and rebalancing it as needed can help ensure that your asset allocation remains aligned with your investment goals and risk tolerance. Rebalancing involves selling investments that have become overweighted and reinvesting the proceeds into underweighted assets to maintain your desired asset mix. Strategy 5. Risk assessment and monitoring. Continuously assess your risk tolerance and monitor your investments to ensure they align with your financial objectives. Be prepared to adjust your investment strategy if your circumstances or risk tolerance change over time. By implementing these risk management strategies and staying informed about market developments, beginner investors can navigate the world of stocks with confidence and build a resilient investment portfolio over time. Time for the soft question. Getting your feet wet is always the second step, before which we will need to learn, get proficient, and then do it. What criteria do you use when evaluating and picking a stock? Please share your experiences in the comment section below. This will help everyone learn from each other and grow together. Subscribe with us and learn. If you find the information in this video valuable, please subscribe and share it with family and friends. Your support will help us create many more high-quality videos like this. Please support us. Please hit the like button and the notification bell to be notified. Click on these 2 videos shown here to explore even more. The contents of this video are for educational and informational purposes only. Thank you for watching.